Imagine having a personal mentor who turned $10,000 into $100 billion. Someone who could teach you exactly how they did it, step by step, principle by principle. For decades, that is exactly what Warren Buffett has been doing through his annual letters to Berkshire Hathaway shareholders. These letters, compiled in the essays of Warren Buffett, contain the most valuable investment education you will never find in any business school. They reveal the exact framework that transformed a failing textile company into one of the most successful conglomerates in history. The foundation of Buffett's philosophy rests on a concept he learned from his mentor, Benjamin Graham: the distinction between price and value. According to Buffett, price is what you pay, but value is what you get. Most investors obsess over price movements, watching stocks bounce up and down like a yo-yo, but Buffett sees the market differently. He views stock ownership as buying pieces of actual businesses, not just ticker symbols on a screen. This leads to his first major principle, the circle of competence. Buffett insists that investors should only invest in businesses they truly understand. He does not care if technology stocks are soaring or if cryptocurrency is making millionaires overnight. If he cannot understand how a business makes money and what could threaten its profits 10 years from now, he simply does not invest. Buffett demonstrates this principle through his own decisions. He avoided the dot-com bubble entirely because he admitted he did not understand technology companies. While others mocked him for missing out, he stayed within his circle. When the bubble burst, Berkshire Hathaway emerged stronger than ever while tech investors lost trillions. The second core principle Buffett emphasizes is the concept of economic moats. Just as a moat protects a castle from invaders, an economic moat protects a business from competition. Buffett identifies several types of moats. Brand power, like Coca-Cola possesses, allows companies to charge premium prices. Network effects, where a product becomes more valuable as more people use it, create nearly impenetrable barriers. Switching costs, where customers find it too expensive or difficult to change providers, lock in revenue streams for decades. Buffett looks for businesses with wide, sustainable moats because they can maintain high returns on capital over long periods. He points to See's Candies, a Berkshire subsidiary, as a perfect example. See's has such strong brand loyalty in California that it can raise prices every year without losing customers. This pricing power, Buffett explains, is the hallmark of a great business. The third principle revolves around management quality and corporate governance. Buffett dedicates significant portions of his letters to discussing what makes great managers. He looks for executives who think like owners, not employees. They should allocate capital rationally, avoid empire building, and communicate honestly with shareholders. Buffett particularly despises what he calls the institutional imperative, where companies do things simply because their competitors do them. He cites numerous examples of companies making terrible acquisitions or entering unprofitable markets just to keep up with industry trends. Great managers, according to Buffett, have the courage to go against the crowd when logic dictates it. This connects to his fourth principle, the importance of long-term thinking. Buffett's favorite holding period is forever. He argues that the stock market is a voting machine in the short term, but a weighing machine in the long term. Daily price fluctuations mean nothing if you own a piece of a wonderful business. He illustrates this with his Coca-Cola investment. Berkshire bought Coca-Cola stock in 1988 when the company faced challenges. Rather than focusing on quarterly earnings, Buffett looked at Coca-Cola's 100-year history, its global brand recognition, and its distribution network. That long-term perspective has generated tens of billions in profits for Berkshire. The fifth principle addresses market volatility and investor psychology. Buffett teaches that volatility is not risk, despite what modern portfolio theory suggests. Real risk is the probability of permanent loss of capital. A stock dropping 50% is not risky if the underlying business remains strong. In fact, Buffett sees market crashes as opportunities. He uses the metaphor of Mr. Market, a manic depressive business partner who offers to buy or sell shares every day. Sometimes Mr. Market is euphoric and offers ridiculous prices. Sometimes he is depressed and practically gives shares away. The intelligent investor, Buffett explains, takes advantage of Mr. Market's mood swings rather than being influenced by them. This leads to his famous advice to be greedy when others are fearful, and fearful when others are greedy. During the 2008 financial crisis, while others panicked, Buffett invested billions in Goldman Sachs and General Electric. He understood that fear had driven prices far below intrinsic value. The sixth principle concerns capital allocation and the power of compound interest. Buffett calls compound interest the eighth wonder of the world. He demonstrates how Berkshire never pays dividends, instead reinvesting all profits back into the business or into new investments. This allows capital to compound tax-free for decades. He provides a striking example. If you had invested $10,000 in Berkshire Hathaway in 1965, it would be worth over $300 million today. That extraordinary result comes not from any single brilliant decision, but from the relentless compounding of reasonable returns over time. Which of these principles do you think challenges conventional wisdom the most in today's world of day trading and instant gratification? Let us explore how Buffett applies these principles to perhaps his most controversial stance, his advice for average investors. Buffett makes a surprising recommendation for most people. Despite his own success picking individual stocks, he advises 90% of investors to simply buy index funds. He argues that most people lack the time, temperament and talent to analyze businesses properly. They would achieve better results by owning a low-cost index fund that tracks the entire market. He even structured his own will this way, instructing the trustee to put 90% of his wife's inheritance in an S&P 500 index fund. This is not false modesty. Buffett genuinely believes that attempting to beat the market leads most investors to underperform it through excessive trading and poor timing. The seventh principle addresses the importance of maintaining emotional discipline. Buffett emphasizes that investing success depends more on temperament than intellect. You need the ability to remain calm when everyone else panics. You need patience to hold investments for years or decades. You need humility to admit mistakes and learn from them. Buffett openly discusses his own mistakes in his letters, from his original purchase of Berkshire Hathaway itself, which he calls his biggest mistake, to his late recognition of the value in technology companies like Apple. These admissions teach readers that even the greatest investors make errors. The key is to learn from mistakes rather than repeat them. The eighth and final principle Buffett emphasizes is the concept of margin of safety. Borrowed from Benjamin Graham, this principle states that you should only buy when the price is significantly below your calculation of intrinsic value. This margin protects you against errors in judgment or unforeseen circumstances. Buffett explains that if you calculate a business is worth $100 per share, you should not buy it at $95. Wait until it trades at $60 or $70. That margin of safety turns investing from speculation into intelligent business analysis. Throughout his essays, Buffett also addresses corporate governance and ethical business practices. He criticizes excessive executive compensation, financial engineering that obscures real performance, and the short-term focus that dominates corporate America. He argues that businesses should serve all stakeholders, not just maximize quarterly earnings. The ultimate lesson from Buffett's essays is that successful investing requires thinking like a business owner, not a stock trader. When you buy shares, you're purchasing partial ownership in real businesses run by real people, with real customers and real challenges. If you would not be comfortable owning the entire business for 10 years, you should not buy even one share for 10 minutes. Buffett's approach demands patience, discipline, and continuous learning. It rejects get-rich-quick schemes in favor of get-rich-slowly certainty. It values character over cleverness, simplicity over complexity, and facts over feelings. The true power of these principles lies not in their complexity, but in their simplicity. Buffett has followed the same basic strategy for over 60 years. While technology changed, markets crashed and recovered, and investment fads came and went, these fundamental principles endured. The essays of Warren Buffett ultimately teaches that building wealth is not about finding the next hot stock or timing the market perfectly. It is about understanding value, exercising patience, and allowing the miracle of compound interest to work over time. If you found value in learning these timeless investment principles, consider subscribing to this channel where we deliver comprehensive book summaries every single day. And if this summary helped you understand Buffett's wisdom, please hit the like button, as your feedback helps us create better content for the investment community.